Hello everyone, I'm Marty and welcome to my October 2024 real estate market update for Greater Vancouver. I have been plugging in oodles of data all day today to get this market update ready for you. So I'm going to jump right into it and bring you up to date in the real estate market. Okay, firstly, let's bring up my table for October. And in general, what we've seen over the last couple of months is a softening of the market. We've seen some slight dips in pricing, but it's kind of the status quo. We'll go into some reasons why that's taking place shortly. But let's look at our different product, detached, attached, and apartments. First of all, for sales activity year over year, if we're looking at houses detached, the activity is down about 10%, 9.8 to be exact. The pricing from this time last year is up 0.5%, so marginal change. And last month we saw 1.3% drop, benchmark price drop in detached houses in Greater Vancouver. For attached townhomes and half duplexes, our activity is up 7.4%, interestingly enough. But year over year, we're still down about 0.5% in price, pretty well the same. And last month, we had a 1.8% drop in townhome prices from this time last month. And for apartment condos, we're down about 5% in activity from this time last year. Prices are about the same. And last month, we had just under 1% drop in pricing. So fairly consistent softening over the summer. Again, we're going to get into why that's happening and what to expect over the next few months. So let's look at particular product, what's hot, what's not. The metric that I use for tracking the activity in the market is, of course, the sales ratio. And as I mentioned before, all the sales ratio is the absorption rate of product into the market, how much is selling in a given month for various product. And if the percentage is below 11%, we're in a buyer's market and there's downward pressure on pricing. If it's between 12 and 20% absorption rate, we're in that balanced market territory. So it's not favoring the buyers or the sellers. But if we're over 21%, that sales ratio is pushing prices up, we're in what we call a seller's market. So those are the breakdowns of our different types of markets that we look at. Let's look at various product in different areas. Let's look at the west side of Vancouver for houses. Now you can see I've graphed this since last year, and you can see the sales ratios last summer. In spring, we got pretty active into late spring, and then in summer it started to drop down. Our last sales ratio at 7%. Let's bring up the stats for houses west side. We're now at 8%. We're still in buyer's market territory at 8%. So there is some downward pressure on pricing on houses, as you saw in my table. If you're looking at attached product for condos and townhomes, west side, you can see we had a very active late spring. Last reading in August was 17%. Let's bring up the stats. We are now at 12%. So you can see that cooling off over the last month at 12% is still in balanced market territory, just above the buyer's market plateau. So let's go into downtown. I separate that out as a different area. You can see we had a fairly good spring in a balanced market territory. It was at 11% in August. Let's bring up those stats. We are now at 9% for condos and townhomes downtown, and that is, of course, a buyer's market. We've just dipped into that, so pretty slow downtown last month. And if we're looking at detached houses now on the east side, now remember, last year was pretty good. In the late spring, we had 24% sales ratios. August was slow at 8%. Let's bring up those stats for houses on the east side. We're now at 10%. So we had a little bit of a blip in activity. And I think what's happened with that 10% sales ratio, we are still in that buyer's market territory, but people are starting to buy the product. The smart buyers are actually out there taking advantage of this market now and scooping a little bit up. So that's at 10%, a bit of a jump in activity from last month. And if we're looking at condos and townhomes on the east side of Vancouver, it's been pretty busy throughout the year. You can see we had some high 20 sales ratios in late spring. Then it started to cool ever so slightly into summer for the east side for attached product. And of course, the stats now show a 19% sales ratio, same as last month, still in very high balanced market territory, just below that seller's market. So that product's still hot even over the summer. So overall, if we look at Metro Vancouver, we are at a 12% sales ratio. And of course, that means that it's balanced, but at the bottom end of balance, listings are up. Last year, 5,885, we're at 7,624. Sales are down. Last year we were at 1,042, and now we're at 909. And the sale price year over year, on average for Metro Vancouver, is no change. So that's just an overall look. Let's look at what's happening with prices. One of my favorite charts, the average price chart. Blue, we're looking at detached homes. You can see what's happened over the years. We're hovering around that peak pricing that we recently had. That's the same for townhomes and the same for condos, apart from the slight drops over the summer. So we're seeing the average prices fluctuate around that peak mark for Greater Vancouver. If we look at the 5-year trend, here was our last peak back in March to May of 2022, and then we had that decrease in activity up until 2023, some increase last year, and then a bit of a dip. We had a lot of activity take place here over spring, and then we started to see it taper down. And if you look at that house pricing index from the peak, we hit that peak in spring, and now we've tapered off of it a little bit for all three products. So again, consistent in Greater Vancouver. And if we're looking at the suburbs, just going out a little bit, looking at detached monthly variances throughout the entire Lower Mainland, you can see on average the activity has been down for the sales ratio, apart from a couple areas. The east side, as we noticed, for attached activity was quite active. This is detached, but still up and detached, and also in Richmond, Pitt Meadows, Port Moody, Coquitlam, and all the way out in Abbotsford, some increase in activity. If we're looking at attached product, again, east side Vancouver, Port Moody, Tsawwassen, Cloverdale, South Surrey, and Langley had a little bit of a blip, but activity down in all other areas. So let's forecast for spring of next year. What's going to happen? Well, what we look at is, of course, our market drivers, and really 3 of them are green and 1 is still orange, holding out. That's preventing most of the buyers from jumping in. Consumer confidence is there. People are confident in what's happening, but they're not buying. And the reason they're not buying is, of course, inflation is good. That's good, and the rates are falling, but the cost of borrowing is still too high for them. Picture yourself, you own a product, maybe a 2-bedroom condo, it's at a 2% mortgage. Right now, to get a 5-year rate, you're at 4.5%, give or take. They're below that, some are a bit higher, but say 4.5%. You're gonna have to get a new mortgage for whatever you're upgrading to, say a house. Your condo's worth $1 million, you're buying a house for $2 million, you're gonna get a blended rate of 4.5 and 2. That's expensive to jump out of that 2% mortgage rate. So we're not seeing a lot of listings come online for those upgrade buyers, and it's the same with the downsizers. A lot of them aren't listing until there's more activity in the market, which will be spurred when those mortgage rates drop further. So this is the one thing we're all waiting for those rates to drop further, and they will. The inventory levels are high and increasing, so we got green across the board except for mortgage rates. So we got lots of buyers out there. He's actually smiling. I'm not sure why he isn't in that graphic, but the smart buyers are getting really good deals out there. There's very little multiple offer situations. We had one last night, and of course last week we had a couple, but that's strategy related as opposed to in general. Buyers are writing offers on places with their subjects. They're not competing. It's a very comfortable time to buy. So the consumers who are buying, perhaps cash-rich buyers are really taking advantage of that market, ones that aren't needing a mortgage to make that purchase. If we're looking at the unemployment rate, this is kind of interesting. BC's holding steady at 5.8%, but Canada, the unemployment rate is increasing. So we're aware of that. Rental rates have actually come down to 3.25 a square foot, and that's down about 6% from last month, which is at $3.46 a square foot. And of course, you got the breakdowns in all the different areas. So rents have come down a little bit. That might be cyclical as well, part of the season. We get those rents really much higher in the summer and in spring. And we might see that change again in the new year. And then, of course, new construction. Under construction, we got a lot of product under construction. That's a sign because developers are seeing that there is going to be an active market next year, so they're building the product now so they can take advantage of that. Now, inflation. Here's the real interesting one. When I was tabulating this data, there's our friend Tiff Macklin with the Bank of Canada holding the market in his hand. Inflation fell to 1.95%. Now, do you remember when it was at 8% and everyone was panicking? Well, now we're at 1.95%, and everybody should be going, hooray, it's low, it's dropping, yay. But it's actually not that great a thing if it drops too fast and if it drops too far. Last month we were at 2.5%. That's over a 0.5% drop in a month. That's really quick. The overnight target rate is now 4.25%. And that's good because it's an immediate benefit for the mortgage rate, the variable rate mortgage holders. And if the bond market reacts with lower yields, then the fixed rates will also follow. And the borrowers are getting excited as those rates fall further and further. So that's a third rate cut in a row. The next announcement is this month on October 23rd. Expect at least 25%. It's possible we might follow suit what the US did, the Fed dropping 50 basis points. We could see possibly a 0.5% rate drop. That would be amazing because that would really set the stage for the new year. So, talking more on inflation. Here's a consumer price index. Now you can see, here's when I was talking, we were at 8% back in 2022. And of course, that whole fiscal tightening policy with the Bank of Canada rate going up to bring that inflation down actually worked, and it dropped down and down and down, and now we're having that immediate drop. So that's really interesting. I made a note of this as well. A quarter of this CPI headline is housing. So the cost of housing and affordability in housing dramatically impacts the consumer price index. Here's what I call the band of happiness for the Bank of Canada, between 2 and 3%. Well, we're at 1.9%. We're here now. So the Bank of Canada is happy up to here, but what happens when we go below 2%? What if it keeps going? Well, one might think that's good. Inflation is going, even if it hits zero, that's good. That means prices aren't increasing. Well, it's actually not a good thing. And let's look at why that is. If we look at zero inflation, or even worse, deflation, what are the problems with that? Well, number one, it leads to lower production and wages. So when nothing's changing in price, a lot of companies and product production is rolling back. And if prices aren't increasing by 2%, we might need to roll back wages in some companies by 2%. You can imagine how employees are going to react to that. It's not a good thing. It also reduces demand from consumers and businesses, which is really interesting, and you'll see why. It leads to lower prices and so on. So it's bad because it leads consumers to spend less now because they think prices are going to continue to fall. It's also bad because it pushes businesses to lower wages or lay off employees because they don't see that production increasing and the profit levels are being affected. And it also makes some existing debt harder for borrowers to service. Maybe they're making less, maybe they're not working at all. So there's a lot of problems when it goes down there. to zero or even below zero. And if you recall, one of the major episodes of sustained deflation in Canada was in the 1930s, the Great Depression. So we got to be really careful. We don't want that inflation rate to fall too quickly, too far, especially around zero, or worse yet, below zero. So that's really interesting stuff that I looked up and learned. We are in sync with our neighbors. Again, there's TIFF. We're down from 2.5 to 1.95, and our neighbors with the Fed, Jerome Powell, is at 2.5%. He was at 2.89. So we are pretty well in line with the U.S. We've got elections coming in both countries. We're trying to encourage people to get back and start spending again, and get that inflation rate to stabilize and maybe even come back a little within that happiness range. But we're doing the same across the border, and that's all good because we need to keep in sync. So we need to continue to reduce that overnight rate. You're going to see it fall more. I'm hoping 50 points later this month. That would be awesome. So we can expect that to continue, and we want to get to the neutral range for that overnight rate of 2.25 to 3.25. I think the average where they're really wanting to get to is 2.75. We're at 4.25, so about another 1.5% would really be perfect. That's where they want to end up, and that is where we are heading. So how does that impact the cost of borrowing? Well, as the overnight rate falls, the mortgage rates will follow depending on how the bond market reacts to that. And also the federal government has helped first-time buyers by introducing some new mortgage rules. So let's talk about what those are. They're targeting the younger first-time buyers. And when we're talking about first-time buyers, we need to refer to what an insured mortgage is. And many of you know an insured mortgage is when a buyer makes a down payment of less than 20%. They need to buy mortgage default insurance, usually from CMHC, which protects the equity, or the money loaned in a property for the lenders. So the first thing they've done is they've increased the cap for insured mortgages from $1 million to $1.5 million. Well, that is really good because a lot of product that first-time buyers were buying was actually north of $1 million. So that's going to allow them with less cash reserve, under 20%, to still buy product up to $1.5 million. And they've also introduced the 30-year amortization. Now that's been available to our neighbors down south for many, many years, and it certainly relieves a lot of the pressure on the qualifications for buyers. It brings down those monthly rates, and it's not just for insured mortgages, but it's for all buyers and investors, and even available in pre-sales. So that's all good news. This will be effective on December 15th. So some new mortgage rules. Hooray, the government did something positive for the real estate market to help first-time buyers. So that's really, really good news. And if we continue along, the cost of borrowing, just plugged in all that data. We're right here now. We're going to continue to see that variable rate fall. The forecast shows that 5-year rate actually taking a bit of a bump. We're going to see if that happens. It depends where that overnight rate goes, but overall we're seeing that trend as mortgage rates fall. There's where we are now on our variable and our 5-year on that downward trend for mortgage rates. It's all good news for people wanting to jump back in. And if we look at the monthly trend over the last, 20 years, you can see where those mortgage rates were between 2015 about 2018, hovering around that 2% mark. Those are the glory days when you could get cheap money. Then they went up, then they went really down, and then they went really up where we were last year and the year before, and now you can start to see them drop down. I kind of like that graph because it shows where we are relative to the last 20 years. So If we continue along, we're looking at the buying power for today's cat. So we bring up today's cat holding his cash out. If we do a quick calc, I'm saying for every $100,000 you're borrowing, let's pick a 5-year rate at 4.37. That's a pretty good rate. You're going 25-year amortization, you're going monthly payment, you'd be looking at about $550 per $100,000 borrowed. So if you're borrowing $1 million, $5,500 per month to service that mortgage. It allows you a quick tool when you're calculating different mortgage rates and looking at your cash flow if you're an investor. So $550 per 100 grand borrowed. That's a good number to keep in your head. Now, let's look at inventory. What's happening with the inventory? Vancouver West Side houses, it's continuing to climb. We had a 70 unit jump last month, so that's good news. West Side inventory levels, condos and townhomes, big jump. Boy, about 160 units increase over from August to September. So that's continuing to increase on the east side houses. We did see about a 50 home jump on the east side for houses, and for attached condos and townhomes on the east side, we saw about a 70 unit jump last month. So the inventory levels are continuing to increase. If we go across BC, you can see from a low back in 2022 that inventory across the province is increasing. So now it comes to the big question everyone is asking, what's next for prices? So if we look across BC, this is a chart I brought up last month and I really like it. You can see when that fiscal tightening policy was introduced back in February of 2022, you can see the monthly unit sales dropped immediately way down. They stopped reducing the rate, increasing the overnight rate, and it started to come back, the activity. Then they resumed raising the rates again, and it dropped again. A couple of sawtooths here, and then the first Bank of Canada rate cut and a sharp increase. So it just shows you that the data reflects the market responds quite dramatically to lower interest rates, which is where we're going. So thus my future prediction of the market getting quite active next year. And of course across BC, if we look at the BC REA prediction, we've got increased activity for home sales for across BC for 2025, and that falls in line as the rates fall. And in conclusion, the real estate market, as I mentioned, is determined by the mortgage rates, the inventory, and of course consumer demand. And inflation is falling, 1.95%, pretty darn low. That's good news for now. The Bank of Canada will continue to drop rates well into 2025. That's good news. And the inventory is good and increasing, so there's lots of product for people to see out there. So the mortgage rates will continue. I don't think the Bank of Canada or the Fed has any choice but to continue that trend to ward off the negatives that we could be facing. The lower rates will, at a trigger point, bring back all the buyers and sellers into the market. I think that is going to be at the point when we see about another 100 basis points. So if they drop 50 this month, that would be awesome. And another 25 and 25, we're at the 100. I can see a lot of people jumping into the market. So the fall market will continue to chug along, but I can see it really taking off in 2025, probably as early as February, maybe even late January. So I predict prices next year 3 to 5%. But if it really takes off, boy, we could get that in 1 month. So really tough to tell where prices will go next year. But if they are going to go, I think it's going to be next spring. A lot of happy buyers and sellers, of course, we've had over the last couple of months. Keep sending your questions. Happy to help anyone out through our brokerage who are thinking of making a purchase or a sale. So get in touch with us. We're happy to help you. That's my market update for October 2024. You can watch this video on all the formats, YouTube, Facebook, and Instagram, and you can download the podcast anywhere you get your podcasts. I'm Marty Pospisil. That's my October 2024 market update. Thank you very much for joining me. I hope you're enjoying this great September, October weather we're having. It's getting cooler. We're still out there doing our ocean swims. The water temperature is about 13 degrees. It's getting very healthy, very brisk. I encourage anyone to try it, but be careful, go slowly. Don't spend more than 20 minutes in the water, and enjoy yourself.